Early in my investing career, I never believed in asset allocation. It was a no-brainer. I was investing for long term, and in long term, a 100% equity portfolio is most likely to give higher returns than a portfolio which has a mix of equity and debt. Then why bother with asset allocation when you will get lower returns? It's simple, right? Well, in reality, it's not. There is a reason why every investment expert will ask you to follow asset allocation. And by the end of this video, hopefully, we will be able to convince you why your portfolio should have allocation to different assets even though you may get slightly lower returns. Hello and welcome to ET Money. Today we are going to talk about asset allocation and why you need to do it even if you are investing for the long term. Now, asset allocation, as the name suggests, is about allocating your investments across various asset classes. So in this video, we will analyze portfolios with certain asset allocations and see how these portfolios perform in comparison to a pure equity portfolio. Based on our observation, we will assess the efficacy of asset allocation. Now this video is divided into 4 sections. Number 1, pure equity portfolio versus 70-30 portfolio. That is a portfolio with 70% equity and 30% debt. Number 2, pure equity portfolio versus 80-20 portfolio. Number 3, pure equity portfolio versus 60-40 portfolio. 4, evaluating the efficacy of asset allocation. That is why asset allocation and its close cousin rebalancing matter. So let's begin with comparing a pure equity portfolio with a portfolio that has a 70% equity and 30% debt. Okay, what if you have a pure equity portfolio on one side and a portfolio with 70% equity and 30% debt on the other? For equity, we have considered the Nifty 50 TRI, and for debt, we have taken the ICEX Sovereign Bond Index. We assumed a monthly SIP of 20,000 in both these portfolios for the last 15 years, so between April 2008 and April 2023. Now the 70-30 portfolio was rebalanced annually in April. Now this point is important. What this means is that every year in April, we brought back the asset allocation to 70-30 by rebalancing the portfolio. Now the table on your screen shows the final investment value for both these portfolios. As you can see, the pure equity portfolio has turned the total SIP of 36 lakh into a corpus of about 97 lakhs. On the other hand, with the 70-30 portfolio, one would have made 93 lakh. That's 4 lakh less. So does it mean asset allocation has failed, as you could have done better by allocating all the money to equity and then doing nothing? When we see just the final values, this kind of an impression is obvious, but the reality is quite different. To assess the need of asset allocation, it would be worthwhile to see how the two portfolios behaved when markets fell. For this, we look at drawdowns. Drawdowns is a fall in the portfolio value from its previous high. The greater the fall, the greater the drawdown. The table shows the top 10 drawdowns of the equity portfolio across time frames and the corresponding drawdowns in the 70-30 portfolio. For instance, after the COVID crash, as of April 2nd, 2020, the pure equity portfolio was down 33.16% from its previous high on January 2, 2020. So on 2nd January 2020, the portfolio value stood at close to 60 lakh. But at close of day on April 2nd, 2020, it had lost 20 lakhs and its value was around 40 lakhs. On the other hand, the 70-30 portfolio fell only 21.77%. On January 2nd, 2020, its value was around 57 lakhs. And on April 2nd, 2020, it stood close to 44.5 lakh. So the 70-30 portfolio fell less by around 12.5 lakh. Thus, the 70-30 portfolio suffered a less steep correction. Now this trend repeated on the other 9 occasions as well. A 70-30 portfolio fell much less than the pure equity portfolio. You can see this on your screen if you look at the last column of the table. The 70-30 portfolio has saved anywhere between 36,000 to as much as 7.37 lakhs. Now we will share the entire data that we are discussing in this video. You will find a link to a document in the description. Okay, this was 70-30 portfolio. What happens if we have an 80-20 portfolio? Will the virtues of asset allocation still be there? Let's see. Let's first see the final value of the corpus for the 80-20 portfolio. This is a slightly more aggressive portfolio than the 70-30 portfolio. The conditions are the same as those for the 70-30 portfolio. So we are checking the portfolio for a 20,000 rupee SIP between April 2008 and 2023. Now, while the pure equity portfolio managed to generate about 97 lakhs, the 80-20 portfolio yielded over 94 lakh, a difference of about 2.5 lakh. Now, let's also see the downside protection in the 80-20 portfolio. We found that even the portfolio's 20% debt component goes a long way in containing the downside. Let's take the same example we took earlier. For the April 2nd, 2020 drawdown, the 80-20 portfolio fell by about 5 lakh less than the pure equity portfolio. So while the final corpus was less by just 2.5 lakh, the drawdowns were much better controlled by adding some debt in the mix. Finally, let's also see the most conservative combination, the 60-40 portfolio. This 60-40 portfolio is by far the most conservative portfolio with 60% equity and 40% debt. Let's first see the final corpus after 15 years with such a portfolio if you did an SIP of 20,000. As expected, this portfolio generates the least corpus. The final corpus is about 7 lakh less as compared to that generated by a pure equity portfolio. But how about the downside protection? A 60-40 portfolio offers the best downside protection among all portfolios. In April 2020, this portfolio contained a downside by as much as 10 lakh as compared to a pure equity portfolio. Let's now compare the final corpus of all portfolios together. The pure equity portfolio may be the most rewarding, but the gains from the 60-40 portfolio, which is the most conservative portfolio, aren't bad either. There's hardly any difference between the final corpus of the pure equity portfolio and the 80-20 portfolio. The difference is quite sharp if we see the difference between the drawdowns in the three asset allocation portfolios compared to the pure equity portfolio. So what does it mean? Asset allocation can help avoid a lot of pain without compromising on the gains too much. With this, let's assess the concept of asset allocation and rebalancing and how it can do wonders for you. Now, in hindsight, if you see the final corpus values, it may appear that asset allocation has little to offer. After all, the pure equity portfolio outperforms all the asset allocation based portfolios. This is obvious as over the long term, equity tends to outperform debt. So if you add debt to a portfolio, such a portfolio would underperform a pure equity portfolio in the long term. So it may seem that by simply staying invested in equities, one would do well. However, the reality is slightly complicated. When you are building wealth through equity, you have to go through its ups and downs, which can be really sharp at times. We all remember the recent market crash in March 2020, when the Nifty fell from 12,000 points to about 8,000 levels in a matter of a few days. Such sharp falls can be unnerving for many investors. It's not easy to see your portfolio crash by a third in just a few days. Remember the first example we discussed. The pure equity portfolio went down from 60 lakh to 40 lakh. It's not easy to bear a loss of 20 lakh within a few months. And that's what gives asset allocation its importance. Asset allocation can smoothen your wealth creation journey. By allocating a certain percentage to debt, you can add a cushion to your portfolio. And as we saw, you don't have to give up significantly on the returns. Even a 60-40 portfolio is capable of getting you to your goals, of course, with much less ups and downs. Now, another advantage of asset allocation and rebalancing is they automatically take care of dilemma of when to invest more in equity and when to book profits. For instance, if you want a 70-30 allocation towards equity and debt, and the market goes up in such a way that you have 75-25 asset allocation, you can sell some equity and buy debt. This will take care of profit booking in overheated markets. Similarly, during a bear run, if this allocation goes 65-35, you can shift some corpus from debt to equity. This will ensure that you buy equity when it's cheap. So you may have this question in your mind, which asset allocation should you opt for? How do you decide whether to opt for 80-20, 70-30, 60-40 or some other combination? Well, it depends on many factors including your age, risk profile and the time horizon for goals. While we are not going in details of that, but for now, if you would like to learn more about fundamentals of asset allocation, you can find in the description of this video the link to one of our earlier videos on this topic. So, to sum up, Here are the virtues of asset allocation. Number 1, it helps contain downside in your portfolio by providing a cushion. It thus helps reduce portfolio risk. Number 2, it takes care of the dilemma of when to book profits and when to invest more in equity. Number 3, it helps reduce anxiety and thus helps one stay the course. With asset allocation, it's easier to get to your goals. With this, we have come to the end of this video. If you found it useful, do share it with your friends and family. And don't forget to subscribe to our channel and do press the bell icon so you never miss a video from us. We'll be back with another insightful video in a few days. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.